Vern Sumnicht, Chief Executive Officer at iSectors.com is here. We're talking ETFs, and this is the Money Life Market Call. Welcome to the Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And my guest today puts it all together with ETFs. His name is Vern Sumnicht, and he is the Chief Executive and Chief Investment Officer at iSectors.com. He also, by the way, runs Sumnicht and Associates, which is a money management firm. If you want to learn more, iSectors.com or Sumnicht.com. It's all linked up at the Money Life Show recent and upcoming guest page. Vern Sumnicht, it's great to have you back on Money Life.
Hi, Chuck. I'm glad to be back.
So we always start with methodology, and when we're talking about ETFs and talking about sectors, it's really important that people understand how you decide where you're going to position your money. So tell us how it works, please.
Sure. At iSectors, we have 21 asset allocation models, and they're designed to be blended by advisors and their clients to meet their specific investment goals. But I'd like to talk about our flagship model, our iSectors Post-MPT Growth Allocation. This is a asset allocation model, right? So we utilize a very quantitative asset allocation algorithm. It's 100% objective, so we're not adding our own subjective inputs. Each month, we have our analysts research changes in over 24 capital market and economic factors. We record those changes to our database, which has 40 years of monthly changes to each factor. So I don't want to get too detailed, but we do some statistical analysis to determine the lag times. How long does it take for a factor to affect an asset class? And then all of that information, including the long history, is looked at. We look at it with a matrix of 9 linear programming equations. And they're simultaneously solved, defined, and come to that asset allocation that is each month designed to provide an optimal risk-adjusted portfolio. So that's a little bit more detail. We talked about this last time back in November, and I gave you a basic thing. This goes a little deeper without getting too complicated. That's the mathematical approach, generally speaking, that we use.
And that approach, obviously, when you're using a quantitative approach, you are looking at the system to sort of tell you what you like. What is it leading you to in these conditions? Because we've had a range-bound market, and sometimes range-bound makes it tough for people to figure out what they're doing. In a quantitative system, that can be true too.
Sure. And I know, last time we discussed this back in November, we were telling you that we thought our model was telling us that we're in a stagflationary environment and that it would continue for a while. And that turned out to be true. We're still pretty conservatively invested. The allocation is conservative, and we think, the yield curve is inverted, and that's not a good sign. And we also saw the national debt go up $1 trillion in just 33 days after that debacle in Washington, D.C. about the debt ceiling again. But that kind of a jump in the national debt in just 33 days is highly inflationary. It's bad for the dollar. It kind of makes us think that the Fed interest rate increases are likely only paused, and that stagflation will continue for now. Although, I got to say now that unlike last time we talked, it's not all bad. I mean, we have seen inflation level out. We also saw the PPI coming in, looking pretty good on Thursday. So there are some signs also with unemployment. Basically, that's been stabilizing with unemployment under 4% since February. So these are some good signs. And when you see the stock market having this narrow breath that it's had all year, been going up with narrow breath, kind of 10 stocks leading the market. But that breadth has been improving lately as well. We're starting to see all the indexes follow that technology index, and that's a good sign. And as you know, the market looks out 6 to 9 months. Considering that the bad news that's out there, right, and the markets rise, it is possible the market's telling us that the outlook will be improving. So that's kind of where we're seeing the, what's kind of going on. We still think it's stagflationary. We're still kind of conservative, but we do see that the markets are leading us to believe there is some improvement ahead, which would be great.
What ETFs is it leading you to? Like, let's bring this down and have the rubber meet the road.
Sure.
In these conditions, given that you're using a quantitative system, we put in the inputs, it's coming back and telling you where and how to invest. What are a couple of funds that are working for you right now?
The portfolio, our model has kind of been leading us back into technology stocks starting in the second quarter. And right now, the portfolio is 30% invested in technology. We're using FTEC. That's the Fidelity's MSCI Information Technology ETF. In addition, we own a 30% allocation to SGOL. That's the Aberdeen Physical Gold Shares ETF. We have a 12% allocation to the Vanguard Materials Index. That's VAW. In addition, we have a 12% allocation to the Fidelity MSCI Healthcare Index. That ETF symbol is FHCL. And TLT, which is a 20-year government bond ETF. We have about a 14% allocation.
And it's interesting
you can see we're still hedging recession with that long Treasury and healthcare allocation.
Yeah, and it's interesting.
And we're also hedging inflation with the dollar, kind of hedging inflation and the dollar's potential drop with gold bullion and basic materials. So it's interesting. It's sort of got that stagflation, allocation, but it has moved to fully 30% into technology stocks in the second quarter.
Yeah, I find it interesting that it's protecting against recession using longer-term treasuries at a time when the yield curve is inverted, which is interesting to me because you can make a case that, hey, this is a good time to be looking out longer term because you're worrying about interest rate risk. But if you're worried about interest rate reinvestment risk, et cetera, that's not necessarily recession risk. So that, to me, is an interesting play.
Yeah, it's a little contrary. It's a little, trust me, our advisors that use this model are not too keen on it either. But in an inflationary environment that seems, with the rising interest rates, it seems counterintuitive. But in a recession, those treasuries can do extraordinarily well, and they certainly are down in value. So it seems counterintuitive. It's also the correlation factor, right? We get a lot of protection with just a 12% allocation there because the correlation is so radically different than the other investments. So it's a good risk reducer or moderator. And it turned out really well in 2022. We had even larger allocations of those treasury bonds, but they really protected the portfolio. So I don't know. I don't like it either.
Well, I didn't say I didn't like it. I mean, the truth is, we know that you're a quant. When you not liking it, but having it in the portfolio is what happens because that's the trust that you have to have in the system. Quickly, when the system overhauls and your portfolio is going to change, is it going to be more about allocation changes in terms of weightings, or is it going to be more about, get some of these out of here and replace them?
We have 9 asset classes that are highly uncorrelated or they have very low correlation. So we don't go large value, large growth, small value, small growth. Those asset classes, you might as well just forget it. They're so highly correlated. If you run a correlation matrix, you'll find them all 80% or higher, or up to 95% correlated when you look at it. Just I don't know why people don't get this, but it's quite simple. When you look at a matrix, you'd never go large diversify, trying to do large value, large growth, small value, small growth, etc. What we're doing is we start with how are we going to allocate the portfolio. We start with 9 uncorrelated or low correlated asset classes. That includes gold bullion, it includes these long treasuries, very uncorrelated, right? It includes technology, it includes real estate, it includes basic materials, it includes financials. So that's not all 9, but you can see that these are uncorrelated asset classes that we begin with in the first place. And then we're trying to optimize, that the diversification among those 9 asset classes.
Well, now we're going to get your quick and dirty take on some ETFs that my audience is particularly interested in. Quick and dirty.
This is the best. This is great. I love this. This is the best. I'm having the best time. I love you guys. I love everybody.
Well, we hope you love what you're hearing from Vern Sumnicht. He is the Chief Investment Officer and Chief Executive Officer at iSectors.com, and we are moving into Quick and Dirty, or the lightning round, if you will, where we get his fast take on some ETFs that you guys are interested in. If you want to participate, send your name, your hometown, and the ticker symbols you want to talk about to Chuck at MoneyLifeShow.com. And we start today with a request we got from Rick in York, Pennsylvania, who wants to know about the Pacer U.S. Cash Cows 100 ETF, its ticker symbol, COWS.
Yeah, we like that. That's a buy. We own that in one of our models. We own that in our domestic equity allocation, and we like it. It tracks free cash flows, and it's looking at the Russell 1000, and it's picking out some of these companies that have large free cash flows. So it's a large cap equity exposure, these free cash flows, and then it's weighted by these free cash flows. So it's really been a good performer. It's a good diversification in an equity portfolio.
So we're bullish on COWS, the Pacer U.S. Cash Cows 100 ETF. And again, that is a buy. Rick in York, Pennsylvania had another request. This for BLOK. That's the Amplified Transformational Data Sharing ETF.
Right. We also like that. Rick's got some good picks. You know, BLOK is highly correlated to Bitcoin, and we like Bitcoin, and they call it a transformational data sharing technologies. But they own things like MicroStrategy. MicroStrategy owns 150,000 Bitcoin. They own things like Coinbase, the largest crypto exchange in the U.S. They own things like crypto mining companies. They're highly correlated, like I said, to Bitcoin, but it's an aggressive, volatile, industry. And so for, investors that are okay with that kind of volatility, it's a good allocation.
So a cautious buy because it's a speculative fund.
Buyer beware, dude.
On the Amplify Transformational Data Sharing ETF, ticker symbol BLOCK. Now, we talked about TLT, the long treasury fund that you were using, but Stan in Driftwood, Texas, wants to know about the iShares 0 to 3 month treasury bond ETF. That's SGOV, SGOV.
Well, Stan's on to something, because I think 5% on treasuries, that's a pretty amazing rate of return. And I haven't been able to say this for a very long time, but, you can put your money in treasury, these short-term treasuries, outperform inflation, right? Inflation CPI is theoretically running around 4%. And if you can get 5% on treasury bills, we haven't been able to talk like that for 40 years, I don't think. So that's a pretty interesting play. And we own these short treasuries in our capital preservation allocation. So I think that's a good buy.
So that's a buy on SGOV, SGOV, the iShares 0 to 3 month treasury bond ETF.
Just go slow and be smart. And
we'll move from treasury bonds to gold, something else that people might want to be using in this market. Stan in Driftwood also wanted to know about the Van Eck Gold Miners ETF, GDX.
Yeah, we did a real deep dive on this recently, Chuck, and looked at the gold miners versus owning gold bullion. Both of these gold miners and gold have gotten to the same place over time, but the volatility is pretty outrageous with the gold miners. What we found is the high cost, right, because of interest rates being so high, the cost of equipment, the capital cost, the cost of people, the cost of fuel, et cetera, has made their fixed cost, I think, go up quite a bit. And I think this is causing this volatility. So we've actually moved clients out of gold mining equities. And prior to that, probably, many years, we've been using the mining stocks. And we moved to bullion, and we've seen great results for that. So I'm going to say sell the gold miners, GDX, and buy the bullion. And what we're using in that bullion area, I actually mentioned it in my portfolio. That was SGOL, the Aberdeen Physical Gold Shares.
So you're selling the miners.
Whoa, dumber than advertised.
That's a sell on VanEck Gold Miners GDX. But in there, if you want gold, it is a buy on SGOL, the Aberdeen Physical Gold Fund.
I love gold.
That's it.
And last, for Richard in Chula Vista, California, and Stephen in Flower Mound, Texas, it's the SDY, the Spider S&P Dividend ETF.
We've liked that for a long time. We own that in our domestic equity portfolio. It's, I think, a great fund. Its strategy is to buy dividend-paying companies, but not just any dividend-paying companies. They're trying to avoid the landmines that you can get with, nice dividends. That is companies that are down, their dividends are up because their price is down or they're having problems, or et cetera. You don't want those. These guys avoid those problems by they're looking for really solid companies. And what they screen for is companies that have increased their dividends for at least 20 consecutive years. So you end up with a portfolio of nice dividend-paying stocks, Coca-Cola, Warren Buffett's, one of Warren Buffett's favorites, Procter & Gamble, Kimberly-Clark, maybe a surprise, Black & Decker. All those companies have not paid, but increased dividends for 50 consecutive years. So this is a good company. I like this strategy. And again, in a portfolio of equities, if you want to be, conservative, this is a really good buy.
That's a buy for the Spider S&P Dividend ETF, ticker symbol SDY. And speaking of buys, well, we've got one more good buy to say. That's the goodbye we have to say to Vern Sumnicht. But Vern, great to catch up with you. Thanks so much for joining me on the show. Look forward to chatting with you again.
Thanks, Chuck. And I hope all your listeners have a good investment experience.
That's Vern Sumnicht. He's Chief Executive and Chief Investment Officer at iSectors.com. They're on Twitter at iSectors. Check out the website for more. And by the way, it's Sumnicht.com to learn about Sumnicht & Associates, his financial planning firm. And we will be back to wrap up this week on Money Life and let you know what's coming next week. So cross the finish line with me together in a moment.